Welcome to this special market and economic update. In this video, we'll discuss the ongoing conflict in the Middle East, the sharp rise in oil prices, and what it all means for investors. As Winston Churchill is often quoted as saying, the farther back you look, the farther forward you are likely to see. Energy price shocks have occurred every decade or so throughout history, and each time, markets have eventually found their footing. Over the next few minutes, we'll walk through what's driving oil prices higher, how it affects consumers and businesses, and what history tells us about how markets tend to respond. First, let's talk about why oil prices have climbed so sharply. Both Brent and WTI prices have jumped from around $70 a barrel to well above $100 a barrel in just a matter of days. The key driver is the Strait of Hormuz, a narrow waterway in the Persian Gulf through which 20% of global oil shipments pass each year. Attacks on tankers and safety concerns have effectively halted traffic through the strait. This has created a domino effect. Without the ability to ship oil, major producers like Saudi Arabia, Iraq, Kuwait, and others have been forced to store their output. As storage fills up, they've had to cut production. This combination has blocked supply and forced production cuts is what has driven prices so high so quickly. For context, prices were at these levels just a few years ago. When Russia invaded Ukraine in early 2022, Brent crude surged to nearly $128 a barrel. Before that, oil reached record highs in the mid-2000s ahead of the financial crisis. In each case, prices eventually stabilized as supply and demand adjusted. Next, let's look at how higher oil prices ripple through the broader economy. For consumers, the most immediate impact is at the gas pump. Prices have risen back towards $3.50 per gallon nationally and could climb further. That said, this is still well below the $5 per gallon levels seen 4 years ago. Higher energy costs also raise the price of transporting goods, manufacturing products, and running businesses. Economists sometimes call this cost-push inflation, when rising input costs, like energy, push prices higher across the economy. This is different from the demand-driven inflation we saw when stimulus checks were issued during the pandemic. That distinction actually matters quite a bit. Supply-driven price increases tend to be viewed as more temporary in nature. Either the situation stabilizes and oil prices fall, or the economy adapts over time. The U.S. is also better positioned than in past oil shocks as the world's largest producer of both oil and natural gas. This energy independence helps cushion the domestic economy more than many others around the world. Finally, let's talk about what this means for financial markets in your portfolio. The reality is oil price shocks do in fact lead to market volatility in the short run. However, perspective is needed. For instance, news headlines have been highlighting double-digit declines in indices like Japan's Nikkei and South Korea's Kospi. What those headlines often leave out is that even with recent declines, these markets are still up significantly over the past year. Markets rarely move in a straight line, and short-term volatility during geopolitical events is a normal part of investing. At the same time, some parts of the market are actually benefiting from higher oil prices. The energy sector has gained roughly 25% this year, and commodities broadly have also risen. This is a reminder of why holding a diversified mix of asset classes and sectors matters. Different parts of the portfolio can respond very differently to the same event. The key takeaway is that portfolio changes in response to headlines are often counterproductive. History consistently shows that well-constructed, diversified portfolios are designed to handle exactly these types of situations. We hope you found these insights helpful. If you would like to discuss how these events may affect your portfolio or your long-term financial plan, please don't hesitate to reach out. We look forward to speaking with you.